Hello, hello, hello. My name is Alex Douedari, and I welcome you one more time to my YouTube channel here. So look, I did a number of videos, recent ones, exposing, I would call them frauds, whether it's the guy that pretends to be rich in Dubai that ends up scamming people with shitty signals and overpromises of hundreds of percentage of results, or a brokerage owner that pretends to be an entrepreneur with good vibes that actually runs a company that solely exists on the misery of other people, capturing people's losses and encouraging them to produce these losses. Today, I want to share with you that it's not just me who has this point of view, that it's not just my misconception, but actually that there is this video here from Anton Kreil with 3.6 million views by now since 2017, where is it 2 hours long. I'm just going to touch on a short part of it today and give you a reaction to it so that you could see that this is the reality of what's actually going on. I want to give you a little bit of a backstory. So my whole trading journey started by, I was a musician. I was producing music and writing and all of this stuff, and made a little bit of money. We went top 10 in 3 countries. At the time, there was charts, was before Spotify. And then I invested it in Forex trading. And essentially, I put the money with a trader who lost all my money in a single day, like over a course of 3 days, but obviously everything was lost on a single day. And then he gave me some bullshit story, and I went to my parents and asked them for help. And they gave me their retirement fund. They cashed out their retirement fund, 90,000 euros, and I put it back into trading. And for a very short amount of time, because of over leveraging, basically we had the money back as a floating on the account, but the next morning everything was gone. So my trading career started with a 6-figure loss. And how did I get into that 6-figure loss? It's by being eaten by this industry, by the dynamics and the realities of what is called the trading industry. And at the time, being a retail trader was much less than today. Today, it's hundreds, millions of people, hundreds of thousands and millions is what I want to say, that are in trading, that have lost money in trading, that believe the narrative of the Lamborghinis and the rich traders and all this crap. And all they end up is bringing their money, their hard-earned money, to the broker. They're losing their own money. It encourages gambling behavior at the client. And these brokers, they really come up with, and they have the huge marketing budget. They come up with all these schemes and relationships with their IBs, introducing brokers and affiliates, to create traffic that essentially brings people that lose their money in the millions of people, in the billions of currency, and that's the reality of this market. And my intention, because in my mentorship, it's all about teaching my students to build their own trading strategy so they stop believing narratives, false education, because also 99% of all educators out there, how do they make their money? From the broker they send you to as an affiliate or introducing broker. So from your losses. How can you trust someone to teach you something about trading when he makes his money from your losses in trading? How does that, and I think the reason why this actually exists is because there's little transparency about it, and most people don't know it. So it's, and because my backstory comes from that, and I earned my way back up from that, through learning how this shit actually works, it is my heart's intention to be a messenger to this reality. And turns out I'm not the only one, which I think is great. And today we want to have a look at Anton Kreil. So let's see what he has to say, or who he is actually. So it's the Institute of Trading and Portfolio Management. Let me make my beautiful face a little smaller again. What you are about to see is the real truth about the retail brokerage industry, so-called trading experts, trading educators, and retail traders. Share this video and help educate others. That's exactly what I'm doing. So, trading the truth. And you see, it's for March 17, so it's a couple of years old, but it's as, real as it gets. If anything, it's gotten worse, So yeah, the guy drives S-Class, travels from Singapore to London. So yes, you can make money in trading, guys, but not how the retail industry tells you to do it. And that's really the point here, that you need to emancipate yourself,
So welcome everyone to this
yourself.
seminar hosted by the Institute of Trading and Portfolio Management. We're lucky enough to have Anton Kreil with us here today, Managing Director of the company, who's flown in from Singapore especially to give this presentation. And it wasn't long ago that I was sitting there in your position listening to one of Anton's presentations back in 2012 with little or no trading knowledge myself and just looking for somewhere to learn. And Anton's certainly been a great mentor to me over the years, as I'm sure he will be with you guys going forward. So that being said, it's my pleasure to introduce our speaker for the evening, Mr. Anton Kreil.
All right. You know, I'm going to skip a bit through the video because it's very long. I want to touch on a very specific part here.
Hi guys, welcome. So
hey,
we're short on time today. It's a huge presentation. We're not going to be able to take questions during the presentation.
Let me jump to a part that I want to start with, which is, I think, around the 10-minute mark.
Basically owned by a couple of companies. By having a monopoly.
Right. Basically, what he's saying there is that even the exchanges, not the retail industry, even the professional industry, is owned by very few hands. You know, the stock exchanges, the CME, all of these, there are like very, very few entities that own all of these things, which means they can dictate how the rules are played. And that might be also, but we'll touch on that in a different video, why, you know, the crypto industry is a big issue to those guys, because it doesn't work like that. It's peer-to-peer. But let's continue.
They can control the market if they want to. How the market is set up, how the players must operate. Who they incentivize.
Who they incentivize,
like
who they support.
We'll come on to it later again. Second, technology. Obviously, technology's played a major role in the last 30 years. First things first.
So here's the thing. I think this is good and bad. Depends on what you do with it. You know, because yes, we do have more infrastructure today. The internet has penetrated and has allowed for everyone to access markets. You know, the speed of our laptops, phones, all of this has made it so accessible. And you know, the processing speeds, the lower cost of production, every phone can trade today. There's so many apps, all of these things, right? So that's why I do think that it lowers the entry barrier. I actually mentioned that in one of my beginner courses, that this is literally the democratization of markets. The thing is that, you know, if you don't do it the right way, then it's literally like driving a high-powered car with little or no brakes, you know? And what's going to happen when you drive a car that has a strong engine without brakes? You're going to speed and you're going to crash. And that's exactly what happens, you know? So I like what he talks about that says, he says like, none of this actually means a trader will be profitable, you know? And I completely agree with that, completely agree. The only thing it does, it supercharges your ability to access market. It makes it easier. It lowers the entry barrier. But does it do anything for your ability to use that technology or to trade markets? Absolutely not. If anything, it exposes you to higher risks, to more danger.
Massively increased. And then that's affected the penetration of retail traders, much lower cost of production. Again, lower barriers to entry. Software, connectivity to financial markets, and everything being organized for you. So making life easier.
Yeah, like a game, gamification, right? I mean, a lot of binary options, for example, they're not as big anymore, thankfully, but it's just like at the click of a button, you know? And even now, like you have these apps, they make everything seem so easy. The gamification of the trading industry, again, puts people at risk of losing money much higher than without it. So it's not really good for them, right?
None of it actually means that the trader's going to be profitable.
Yeah, the opposite.
It just means you're supposed to have better access and better capability.
True.
It's supposed to help you more, but it doesn't necessarily mean you can make money.
In fact, the
Regulators.
opposite.
Every problem we've had in the financial markets in the last 30 years,
so interesting.
The regulators done nothing to stop it before it's happened.
Right. So regulators basically, they're not, proactive, they're retroactive. So, but nonetheless, if you look at this, in 2010, contracts for difference were banned in the US for retail traders because too many people lost too much money in the financial crisis. The product was perceived as gambling mechanism due to 10x leverage. Now, even today, we still have CFDs in Europe, in Australia, in the UK, and it used to be 100 to 1 leverage not too long ago. And in the US, it's never been that much, and they banned it like over 10 years ago. Next thing, in 2010, IB contracts were banned by the regulator in Singapore. Now, it means that you could not introduce a client to a broker anymore to get kickbacks from the broker. And that's really, if you look at these things, even when they look to be retroactive at the time, considering this information today in 2021, it was still an early good move. Because what do we see today? We see today that contracts for difference, which is basically just a synthetic product. You never really trade the currency market or the stock market or the commodity market. All you're trading is a synthetic financial contract that mirrors the price of the real asset. And the counterparty, meaning who you trade this contract against with, is your broker, and meaning again, you lose, the broker wins. You win, the broker loses. So he has two reasons not wanting you to win. He wants your losses, and he wants to avoid to lose himself, which is why he doesn't want your profit to happen. And IB's next big thing. Most brokers today, they have these massive marketing budgets, and they bring in this flow of, even today's like online marketing, a lot more, like this affiliate marketing. So all they bring is people to the broker, and they get paid. Actually, they calculated it in something that's called CPA, cost per acquisition. This is how brokers calculate. Now, it means is that if I'm a good affiliate and I can bring 1,000 clients to you a month, and the broker is willing to pay me 500, 600, even 1,000 euros per single client that I bring, because the broker knows that this client statistically is going to lose all his money with us. And this is where all these signal people came from that became an epidemic in the UK, for example, all over the world. Like, hey, just follow my signals for 1 month. I give it to you for free. And all you got to do is to go to this broker, open an account, deposit $1,000 and follow my signals. What's going to happen? You follow those signals. You're going to lose your money. The broker takes this money and pays it out to the affiliate to some extent and keeps it for him. This is how they're making billions, guys, right? So really you need to understand that whenever you see someone on a social media that is sending you to a broker and flexing and flossing with riches, let's just say, cars, traveling, whatever, then you should not look at this person with admiration. You should look at this person with disgust, because this person is a thief. He's stealing from you, from your mother, from your father, from your brother, from your sister, from your friend, from your cousin, from everyone. They are totally agnostic to who they're stealing from. They just want to steal from everybody. And they don't even think that they're stealing. It's just an industry. We're just, people are going to lose anyway. But the whole industry is built this way, and Anton goes into that a little bit more. So let's listen to what he has to say here.
It's always happened afterwards. The regulator is always passive and reactionary in pretty much every geography in the world. So in 2010, one of the main instruments that retail traders use are contracts.
Let's skip through a bit here.
Okay. So IB stands for Introducing Broker. We'll go into the details on those later. But essentially it means that people introduce retail traders onto the broker's platform and get a kickback for doing so.
Right.
They were banned in Singapore in 2010. Why do you think they were banned?
Why do you think they were banned?
Why do we think they were banned in Singapore? Because they're great? Conflict of interest. Hit the nail on the head.
That's the big word here. Conflict of interest. Everyone in this trading, almost everyone, 99.9% in this trading education industry has a conflict of interest. every signal provider has a conflict of interest. Like 99.9% of them, they make money from you losing. They don't have an interest of you to win. So you want to learn from someone that makes money from your losses? You want to follow someone else's trading signals that makes his money from your losses? You know, like, it doesn't really take smarts to understand that, right?
Loads of bad people were turning up into Singapore, like they do all over the world, and teaching people absolute nonsense, putting them on trading platforms, and everyone was blowing up and losing their money. So the regulator, government.
And that's why, guys, there is no one single strategy that works, trading strategy. There's so many, let's just say, working pieces here that you need to create your own trading strategy. You know, does it fit your life circumstances, your personality, your abilities, your talents? All of these things matter. How you see things, how you react emotionally to them, how you train yourself in all of that these processes. That's what I teach in my mentorship. I empower people to develop their own instead of trying to shove something down their throat that pretends to be the Holy Grail while I'm making money off of them on the backside of it from the broker. And this is what 99% of educators do. They say, like, I have the Holy Grail, and my Holy Grail is going to make you rich, and all you got to do is what I tell you. And in reality, you're making them rich from your losses.
Stepped in and banned them.
So that's why
and this is very typical of regulators. They do it after the event.
And actually, Europe reacted, so they reduced the leverage to 20x, for example, or 30x, but that's still massive, you know, and I don't think people actually understand that.
So what does that mean if you're a retail trader? Well, history tells us, as a retail trader, you have to regulate yourself, because the regulator's not going to save you.
You have to look out for your own, basically, for yourself.
You'll lose all your money, then they might change a law afterwards. Doesn't matter, you're done, you're out the game. Financial markets volatility. Volatility in
yeah, let's skip through this a little bit here.
Day 6 because of a retail trader.
Wait.
In the vast trader 1 takes 50% risk per annum, annualized volatility in their portfolio. You can measure the volatility of a portfolio. Very easy. 50% risk a year and gets 25% return. And trader 2 takes 10% risk per year and makes 16% return.
Simple, you know. If someone uses 50% drawdowns in order to make 25% a year, then that's bad, because he's risking twice as much as he can make in the best case. When someone risks 10% and ends up making 16% over the year, and that someone is a lot more preferred, because he takes a lot less risk, right? So that's actually a simple one, but most people, again, don't understand. People are chasing the 100% of returns per year, and they don't even look at what is a risk-adjusted return. You know, you make 100% a year, great. What's your risk of making that 100%? Oh, 100% risk? Shit. Now, what happens if you lose the 100% risk first, before you make the 100% profit? Because that may happen any moment in time. You don't know when the drawdown is going to happen. That's why you want to go with the trader who has a maximum risk of 10%. Because even if that happened and he had a second round of trying again, with again 10% only, there's a, you know, this makes sense from a mathematical perspective. However, if you risk 50%, 100% of your account, you may get kicked out of the game any day, completely, with all your money. And that's the risk a lot of people do. They only look at the profit percentages, and they never look at the risk-adjusted returns. And this is where the actual information is, you know?
Who's the better?
So let's go through this a little bit more here.
And even if it's higher or lower than consensus, which is economists, the professional traders have predicted that it's going to be higher or lower than consensus. The retail trader, one professional trader's broker is the investment bank. That's an institutional broker. Let's think about...
Yeah, here we go. Like retail independent trader, unrealistic high expectation targets. They stay poor because they're looking to get rich quickly, but they end up to get poor quickly. Their expectations are wrong. Their targets don't get met, and they blow up. And who benefits? The broker, you know? And that's, you know, it's very simple math here. Typically, brokers will spend 30 to 50% of their commission spread revenues, actually they make from losses from the BBooks now, on marketing for new clients in order to replace their clients. So they have a churn. Brokers always need new clients. They need new clients, new clients, new clients, because no client survives, you know, and the clients that survive, they don't want them because, again, your profits are their losses. So they don't like it. So that's why you have to be very careful with which broker you choose.
In ratio. You'd be the best trader in the world. So what we're going to show you here applies mostly to international markets outside the US. As we mentioned earlier, US CFDs were banned. So if you were to buy a CFD on a stock.
Right, that's the 90-90-90 rules. 90% of traders lose 90% of their account size within 90 days. And that's pretty much accurate. And that's the main metric brokers function on. You know, they know that 90% of people are going to lose. And all they got to do is encourage them to lose and be on the other side of the trade. Great business model, right? Unless you start to understand and realize that and stop feeding that machine.
It's a contract that is supposed to mirror, and you're done. Your account's blown up.
That's so
Stock goes in your favor.
Like what
the
he
broker
says here.
pays the difference
Because
into
that's why high leverage is so insanely dangerous.
your account. Contract for difference. If you have the reverse situation, the broker takes money out of your account if you're losing money. And what happens when your margin goes to zero? You get a margin call. You have to deposit more money in your account.
Yeah.
And if you can't, the broker will stop you out of the position.
Stop you out
and you're
to
done.
take all your money.
Your account's blown up. So that's why we call them contract for difference, because the difference is taken out or put in.
Right.
Typically in Forex, obviously Forex is a very popular instrument for a popular asset
Still
class
is.
for retail traders. Typically in Forex, whatever you deposit in your account, you are allowed to borrow up to 100 times that.
So think about that. In Forex, I mean, okay, these leverages are lower today, but still 20 or 30 is still a high number. But if you take a trade, and I just, that guy that I showed you an Excel trade proof from, which is such a joke, he encourages people to trade with 100 to 1 leverage per single trade. That means if the market goes against you, only 1% price move against you, you're going to lose all your account. Understand? As little as 1% market move is going to deplete your own account, crash and burn it, and the broker's going to take it. And this is the kind of leverages you get encouraged to trade, you know, and you wonder why you're losing your money so quickly. So people just say, I'm just trading one lot of Forex. Yeah, one lot means 100,000 in the base currency. 100,000. If your account is only 1,000 large, you're trading in one position 100 times larger position than your whole account is to begin with, you know. And this is why you lose all your account with as little as a 1% market move, you know. And if you don't get these basic straights, guys, then please don't trade unless you want to gamble. Different story, you know. But if you think you're going to make it in trading, or you want to make a career in trading, or you want to create an income or whatever, then you cannot treat it like gambling, because there's people out there that systemize this gambling. In gambling, there's the saying, do you know who always wins? The casino. So who's the casino? Put your money on the chili, right? So let's look what else we have here.
And what are they doing? Taking $200,000 positions in Forex and blowing up in days.
Right, that's what he just mentioned. But I'm saying, insane.
100 times leverage, we call it. With stocks, commodities, ETFs, you're looking at 10 times leverage.
Yeah.
So the numbers
Still
work
same.
exactly the same.
Yeah.
If you lose 10%,
Right.
you're out.
Massively over-leveraged. Will cause
But think of
damage.
all these guys on the
and-
platform trading in the way that we've discussed, in the opposite way, the way retail professional traders do it. Wouldn't it be amazing if we ran a company where we could just take the other side automatically every time they traded?
That's what brokers
We'd
do.
win 90% of the time. And this is the big problem. The way the brokerage industry works is that there's major conflicts of interest with retail traders. So major conflicts of interest between the broker
and his
and
own
their
clients.
clients, the retail trader. That creates a scenario where that literally happens because those guys want it to happen.
Very important what he says. And I mentioned that in my last video, service to self versus service to others. The brokers want that to happen. They create all sorts of marketing schemes and encouragements for this to happen. It's not a coincidence that 90% of people are losing. The broker wants this to happen because of the apparent conflict of interest, and he wants to push it in that direction as much as he can in order to collect as much as he can. And we're talking billions, guys, billions.
The infrastructure has been built not for your benefit. Your objective is to turn up and make money. That's not their objective.
It's not.
Their objective is the opposite to yours, which is to take your money.
Take your money. I made a song actually, which is called Until They Take Your Money. You can find it on my YouTube as well.
So the first two conflicts of interest are really obvious. There's four main conflicts of interest. Spread and commission.
Right.
So spread. What?
So spread, you know, if there's no real market behind it, no real execution, why is there a spread? So that difference, the broker is pocketing in automatically, commission as well, with every trade you make. Simple as that. This is already a loss to you. You open a position, you're instantly in loss because of the spread and the commission. Add to that extent. And that goes completely in the broker's pocket without needing to have any execution costs on his back end. So that's number one. That money he makes on top for free, basically, every time you open a position.
What's spread? Well, if you buy something, you're buying it in the market, for example, at...
Oh, and here, financing turn. That's the next thing. He's probably explaining now the whole situation with swaps, because this is where the leverage comes from. You know, basically, a broker gets a credit line from a liquidity provider or investment bank so they can offer more money. You know, this is where leverage comes from. For that, they need to pay financing costs. Now, what they do is they add to these financing costs on top and take from their clients even more. So essentially, you are paying to finance the broker's credit line. And OTC gain, basically, they take the money on the other side of the trade.
At 6, and if you sell it, you're selling it at 5. So the broker makes 1. You pay the spread. So if the broker has 2 clients, the broker can buy it at 5 and sell it to you at 6. So 1 seller, 1 buyer. They make a spread. So they make a spread on every trade and take turns. We'll use this phrase again in a second. The word turn. Taking a turn,
round turn, basically,
is buying something at 5 and selling it at 6. The other two, not so obvious, this is how it works. So the first one, financing turn. Who finances the leverage with brokers?
That's what
Does
I just mentioned,
the magic money fairy from the sky come down and give brokers money?
The
to
money
lend to you?
fairy.
Where does it come from? Comes from investment banks. So if you want to set up a retail brokerage company, get yourself $30, $50 million, go to an investment bank, use that money to collateralize some debt, and ask them to borrow $250 million. Ask them if you can borrow $250. You get yourself a revolving credit facility, build a trading platform, and then farm out the credit on the platform to retail traders. So you borrow at, pretty much now, this will be the case,
Say
you borrow at
2.75?
2 3/4, farm it back out for a point higher. So you take a financing turn on the debt. But what else gets collateralized? How do you get away with turning up to the investment bank with only $30 to $50 million regulatory capital and then borrowing $250? How do you get away with that? Because retail traders are going to open trading accounts. And when...
And that's the thing, you know, like everything is completely built to create losses to you or to put more and more and more costs on your side, you know. And even if you think about it, how easy is it to open an account today? It's like literally 2 minutes, you know. And again, basically you're getting yourself into a race car without brakes, and you're not even noticing. You're just in it for because you love fast cars and because somebody showed you how great it is to drive a fast car. And what you do is you kill yourself financially. Is that what you want to do? And you know, let's have a look at one other thing here that I just prepared here some things. Why BBook? This is called BBooking, when the broker takes the position on the other side of the trade. You know, So it even created an industry around that. You know, like for example, there's these companies here. Forex TG, a merge of Forex and cryptocurrencies has altered the prospect of industries and has developed digital marketing. Our team, comprising experts in field of Forex cryptocurrencies, uses old and new means to facilitate an efficient marketing in Forex for you. Our marketing experts and consultants help you create grand demand and fortify your market value to make sure your project has the most potential in the market. You know, or even training. They train your educators as to, just trade, you know, like easy technical analysis stuff, and don't build more sophistication around your strategy, and watch yourself lose and lose and lose. You know, BBooks also, they sometimes when they see that you are able to make money, they switch you to what they call a book. Basically, then they don't take the other side of the trade. But when they do that, your execution gets a lot worse. Suddenly you have a higher spread, you have slippage, all these things, and they don't tell you about it. You might be a book, you might be BBook, and you know, so again, you're basically taking here the bad side or the bad end of the stick. Again, BBooks also encourage dishonesty and can be proven by brokers that they're not even disclosing or even lying about how they make money, their profit models. You know, the other day when I showed you that for Naga, they needed to publish it in their document, but not every broker needs to do that, you know, and even when they publish it, 99.9% of people on their platform will never see that or never understand where to look and what it means. And that's the thing. BBooks encourage bringing on dump money with $1 million per month marketing budgets and high leverage to blow their accounts. The higher the leverage, the more you need to run, because you know this is only created so you lose faster. Also, BBooks are incentivized by mispriced ticks. Oh, you trade over news, they widen the spread 10 times as much, and you get kicked out of your position. Oh, you trade overnight? Oh, sorry, the price went 20 pips up or 50 pips up for just a second to kick you out of your stops, you know? And all of these things, because whenever you close a position and loss, it ends up in their pocket. All these things happen. And this is, I think, is the most interesting one. And I think this is what is going to bring brokers to their knees, especially if you compare of what is happening in the crypto world and in the DeFi world. BBooks have created a culture of these companies to be too fat, really, to become, they're not hungry for any sort of innovation. They're not servicing their clients. They're just, you know, have these schemes, and they try to blow up these schemes in more and more and more and more countries, and that's it. So they have no innovation on the side of servicing the clients. So these companies, they're going to service their clients. They're going to look for innovation. They're going to come up with it. They have more resistance for the moment, but essentially they will win. Innovation always wins, you know, because this kind of stuff can only exist in the shadows when it's concealed. And I don't think that this can continue to happen like this forever, you know. And if you don't believe me, by the way, this is a number from 2019, so even before the C19 year of trading and all of that. And you can see, like, the corporate regulator has accused global financial companies of flogging billions of dollars of risky derivatives via Australia. Regulatory arbitrage that has caused $2 billion in losses to 1 million investors. So only in Australia, because Europe had like low leverages, the ESMA had changed that, but Australia had not. Meanwhile, Australia has as well. So just for this arbitrage of regulation, meaning that people were going to Australia because they had higher leverages or they were sent there, they lost $2 billion in the year 19. I don't even want to know how much they lost in the year 20 or now in 21. You know, so that regulatory arbitrage is even worse, because brokers they even send you you think you're opening an account with a European regulated entity, a UK regulated entity, and then they send you to their sister company, same name, same everything, same platform, same login, in Mauritius, in Seychelles, in Vanuatu. And then you have, again, the high leverage, but you also strip yourself of all the regulatory protections. So you can't even complain. And if you go to your local regulator, he says, like, sorry, you're with a different entity. And if you go to that island's regulator, they're going to say, oh, yeah, let me see what we can do for you. And that's kind of everything you're probably ever going to get in a response. So you see, guys, there's so much stuff going on here that you need to be aware of. And this video was meant to bring more information to you, to empower you, to make the right choices. Can you make money in trading? Certainly. Can you build a strategy that works? Certainly. Can you, not fall victim to this crappy schemes? Very certainly. What do all these things have in common? You are the one responsible. So if you want to, emancipate, build the skills, become capable, stop, looking for the easy way and for other people to take advantage of you, take your money and, make a fool out of you and make you poor in the process, then, you need to work on creating your own strategy. And that's exactly what I do in my mentorship. And this is what I want to stand for, to empower people, to empower themselves, to build skills, to become capable, and not to fall victim to this bullshit anymore. So, if you liked the video, please leave a like. Let me know your comment. What do you think, actually? Have you been victim to the schemes before? I'd really love to know. Leave me a like if you liked it. Subscribe to the channel. And I look forward to see you on the next video. Bye-bye.